One of the assets that really took a huge hit during this market crisis have been the REITs, real estate investment trusts. And today we'll talk about them, we'll explain what they are and understand how exactly can we benefit from all of these opportunities and if there are even any opportunities at all. So let's get into it. So what the hell are REITs? REITs are basically real estate investment trusts. These are indirect investment vehicles, very similar to mutual funds. In the case of real estate investment, we can actually see that these funds actually not only invest into different real estates, but can also operate them, which differentiates them quite a bit from the normal mutual funds. They behave very similarly to stocks. Well, they do trade on the stock market, so that it is to expect that they actually behave like a stock. One of the most important things, however, are certain special characteristics that basically make a corporation into a REIT. So let's actually look at these characteristics. Number one is the REIT must be owned by at least 100 shareholders. Number two is that 70% of all of their investment must be into real estate, government bonds, or cash. Number three is that 75% of all of their returns must come from real estate. And number four, and probably one of the most interesting one, is 90% of all taxable income must be given to shareholders, meaning that 90% of all income is basically given to shareholders in the form of dividends. By doing that, they can basically create certain tax exemptions. For example, most corporations pay taxes on income. So whenever they earn that income, whenever they earn the profits, they pay taxes on it. With REITs, this doesn't happen. They actually pay taxes only after they pay everything to the shareholders. Meaning that if they earn $100 million, they basically need to pay $90 million to the shareholders. This leaves them with only $10 million in the bank, and that means that they're only gonna be taxed on those $10 million. This creates great opportunities for the investors, since it actually gives you a far bigger dividend yield than pretty much any other company can give you because of those tax exemptions. So let's actually look a little bit more at how they actually work. There are two different types of different rates. The first one is equity rate and the second one is mortgage rates. Far more popular one is the equity rate. Equity business model is very simple. They basically lease spaces to other businesses, and they can also operate that real estate under someone else's name. That's it. Mortgage rates are a little bit different. They actually earn cash by giving loans to other real estate owners, and in turn their income is basically the interests on those loans. The second ones are a lot more difficult to analyze, and they're also much more rarer because basically they do the same job as, for example, banks do. So yeah. In this video we will almost exclusively look at the equity rates because they are far more interesting, in my opinion, to look at. So as we can see on the screen right now, there are so many different equity sectors that we can choose from. There are offices, industries, retail, lodging, infrastructure, healthcare, data centers, and all of the other ones. There are also diversified ones that basically look at that comprise themselves of many different sectors. So let's actually now look at the past returns and exactly what we can expect moving forward. The main four factors that determine the return on our REIT investments are the following. Number one is the dividend yield. Number two is the dividend growth. Number three is equity growth, and number four is market expectations. So if we look at the past decade, we can see that the average return was around 10.7%. This of course is completely taken out of the context, because if we actually look at the graph, we can see that that return was really benefited from the crash of 2008. Most of the real estate was really underpriced, and that's why the return was so big. That's that fourth factor, the market expectations. People didn't expect much, and since they didn't expect much, the prices were lower. Since the prices were lower, there were more room for up growth. Yet if we look at the historic rate of returns on rates, we can see that it's quite funny, the picture, because it actually beats the market, beats the S&P 500 over the last 40 years. So looking at the past, we can see that they have incredible growth. So what kind of growth can we expect in the future? Historically, the REIT dividends have been around 40 to 60% of all returns on that investment. In the past, we can see that the dividends have been around 3%, 3 to 4%. So for example, if dividend grows 2% in the future, we can see that basically this will give us around 6% per year. Plus, of course, the appreciation of the capital, which can happen very quickly, especially now that the Fed announced that they can basically put as much inflation as they really want to. This actually is a great hedge for that inflation because the asset prices will go up, meaning that our returns will also be basically maintaining its value, if you will. So far more realistic expectations would be somewhere around 8%, I would say. 4% is of course the dividend, and other 4% would be up to the investor to find a deal which is undervalued, which of course can give us more returns in the long run. Or number 2 is a company that can invest and expand really effectively. Now let's actually look at the ways we can determine the value of some of these REITs. So there are basically 3 methods. Some of them are good, some of them are not so good, but let's go and check them out. So number 1, we have the dividend yield. This is by far the most basic one, of course. As we can see, the dividend yield is basically the correlation between the price on the market and the dividend that this company is paying. Yet, it's very difficult to say that if the dividend yield is high, then the investment is good, or vice versa. This has to do with the fact that there are 2 main variables that basically don't play together very well. What I mean by this is, for example, let's look at the period of 2008. The dividend yields have been incredibly big. Yet, if you look at the actual dividend payouts, meaning that the amount of cash that the company is paying relative to their earnings, we can see that they actually are at around 200%. This means that basically the companies are taking out loans and basically destroying their liquidity in order to pay the investors more. This is basically an artificial dividend yield that will not be continued moving forward because, well, the companies will go bankrupt if they do. Number 2 is the FFO or price to FFO. This basically is the same as price to earnings. In this case, FFO means funds from operations. Funds from operations are basically the cash flows from the operations of this business. So very similar to how you would evaluate a business, a normal business, the higher the PE ratio, or in this case the price to FFO, the lower the returns will probably be. So if we look at the historic chart, we can see that contrary to the S&P 500, the REIT industry has actually had a pretty stable price to earnings ratios. This is very interesting because, once again, this has produced really good returns over the past 40 years, and so it's very interesting that there's not that much interest in these kinds of investments. And the third and final one, and this is very similar to what Security Analysis by Benjamin Graham basically shows us, is the net asset value, or NAV. This basically means all of the assets minus all of the liabilities and minus all of the intangible assets. This basically gives us the book value or the equity of the business. If the price of the business is below that equity, that means that the business is actually supposedly undervalued. Yet that's not always the case, because sometimes the companies can be really badly run, and that means that their asset values will start to decline in the future. What this gives us is basically the realistic expectations of what's to expect in the future. So let's actually look at the current situation and determine if this investment is actually something interesting. So if we look at the graph on the screen, we can see that during the crisis, the REITs value in general has actually come down quite significantly. They haven't really recovered, and they have been pretty much stagnant over the last couple of months, and I think this presents us with an incredibly great opportunity to actually benefit from that decline. Of course, I'm talking right here about the global ETF market. I'm not talking about any specific field. Of course, the global ETF market will encompass both the winners and the losers, and this will basically give us a very medium return. This is of course perfect for any passive investments, if you will. Now, yet, if we look at the individual stocks, we can actually see that things get a lot more interesting. For example, some of the fields or sectors of the REIT industry have been hit particularly hard and present particularly big discounts. Fields such as retail or lodging can have incredibly big discounts, and yet not all of them are without its merits. We need to remember that this crisis has changed particularly how the structure of all of these businesses work. No longer people are willing to go to the malls as much as before due to the simple circumstances of life. It is much more easier now to basically go ahead and purchase things online. And since people started doing that more and more now, going back is not going to be as easy as before. For the hotels, for example, the question is, will people actually be willing to stay in those? The obvious answer is yes, and yet there's still a structural change in how those businesses work. This is why there's such a big confusion around them, and this is why some of them look to be extremely undervalued. Yet, once again, not all of those complaints are without its merits. And so here are the three factors that I consider to be the most important in order to get a perfectly good deal even in those distressed assets. So number one is having good liquidity and having a strong balance sheet. Both of those things are extremely important for a REIT, and especially a REIT under distress. If the company has some kind of liquidity, they can basically survive for longer, and as well as they can adapt and improve their real estate in order to satisfy the new markets. Overall, pretty much all of the real estates have entered the crisis with a pretty good situation. If you look at some of these graphs, we can see that pretty much everything looks really good. Debt to equity on assets have risen, of course, but now it's actually coming down. The developmental pipeline have not been hit that hard. A really good sign as well is that there's not a lot of dispositions. This means that basically companies in general are not trying to liquidate most of their assets, because if they try to do that liquidation of assets, that probably means that they do not have any liquidity at all. One thing that does preoccupy me a little bit is the huge decline in interest rate coverage. But overall, as we can see, the picture isn't that bad. Yet, of course, things can get worse. And this is why they need that liquidity, and that's why they need that strong balance sheet in order to basically take any damage that may come in the future. Number two is the management needs to be competent. This is a no-brainer, I think, but in general, REITs have been one of the slower pace industries. This is of course normal since the real estate industry isn't as fast-paced as, for example, the tech industry. They can actually be quite passive, in fact, and still have good returns because, once again, this is real estate. Most of the leases have been prolonged over the last decade. This means that basically there's more time that the lessees stay in that real estate, meaning even less work for the management. Yet times like these, and especially for the distressed assets, this is where the competent management really needs to step in. They need to take very quick and focused action in order to prevent and adapt to these new circumstances. As we have discussed before, much of the real estate that's have basically no use right now can be transformed, and yet it can only be transformed if the management is efficient. Probably the most simple and the most showing metric to actually understand if the management is competent and if it's efficient is by probably looking at the returns on equity and returns on assets. If that number is above industry average, this means that basically they are aggressive to a point where they are not afraid to cut the assets that do not produce any cash and basically invest into other assets. And the third one, and by far the most important one, I think, is the discount on the asset. So, of course, following the Benjamin Graham ruling, the bigger the discount on the assets, the bigger the margin of safety. This has never been more true than for the REITs industry. The bigger the discount we can take on the existing assets, the more leverage that we have for that investment, the bigger the security we have, and the more returns we can possibly have. If the discount isn't enough, we may run into the risk of either losing capital or not even having that good of a return in the end, even if the company is able to transform and to overcome those hurdles. So once again, it really comes down back to the investor and how much risk you're willing to take. So that's pretty much it. I've explained everything you really need to know about the REIT business and what we can actually need to look for in the current market. I think this is a very interesting field to actually be looking into right now, simply for that discount that happened after the crisis, both for the market in general and specifically for very specialized REITs. I've actually invested in one of these REITs, and I'll probably make a video of this later down the line and explain exactly what kind of investment I made and make the analysis of the company, similar to what I did with the CD Projekt Red in the past video. If you haven't checked it out, make sure to do that. It's on my channel, and yeah, that's pretty much it. Let me know what you think about this REITs. Let me know what kind of REITs you're investing in, if you're investing in any REITs, and I'll see you next time. Bye bye.